Very good afternoon, good morning. Welcome to HYCM's live market analysis with myself, Giles Coughlin, a chief currency analyst. I do hope everyone is well and looking forward to making sense of the market.
Just saying that the Russian delegation has suspended its participation in the Parliamentary Assembly of the Council of Europe. That's according to RIA. And remember, we heard that Ukraine's President Zelensky had also made that move a bit earlier. Later reporting suggested that the Prime Minister of Ukraine would be attending, but it looks like the Russians...
Okay, just an interesting breaking headline. We'll cover all of that at the moment, but I've got some breaking geopolitical news, so I was just keeping my ear out to the squawk. Right. A very good afternoon. I'm looking forward to explaining markets, what's going on, as well as the key risk events that we have this week and how that dovetails into the current geopolitical risk. So hello, Nahar, welcome if it's your first time. Jay, good to see some regulars here. Richard, Stefan, Warren, good to have you here, folks. Don't forget, as we look through different entries, exits, the whole idea of this webinar is you're looking over my shoulder, someone with a professional trading background, and you're going about to see how I understand markets, how I define, limit risk, and the whole idea is that this helps you with your own trading decisions over time, etc., etc. A number of people who have been on this webinar for years can reflect that. A couple of big meetings this week coming up: the Federal Reserve meeting and the Bank of England meeting. We'll be covering both of those, and also I'm just going to go through some general, pictures of what's going on in the market, as well as like why the yen structurally weak and should stay structurally weak for the medium term. And we'll also look, Russian-Ukraine crisis, what the trade is if a solution, peaceful, result is found. Very dark times at the moment, and it's going to be one of the most vulnerable times that the global stage has been in, certainly during my lifetime, with the risk potentially for this to spill over to a wider conflict. So we are living in very dangerous times that extend far beyond financial implications, which is a very sad state of affairs. Right, I'm going to go over to my trading screen now and just explain to you what's going on. Before we get stuck into the events, I want to just give you the big picture of what's going on. Right. So that latest geopolitical headline here, and this is courtesy of Financial Source. I am one of their daily analysts leading analysis on the daily webinar on that platform, and HYCM clients can get access to Financial Source, so don't forget that is a service there. Please contact your account manager if you'd like access. Now, the move here with Russia suspending its participation in the Parliamentary Assembly of Council of Europe, that was sort of on the back of some earlier comments coming up about 11 o'clock with the Ukraine President Zelensky withdrawing from his Council of Europe speech due to very urgent, unforeseen circumstances. So there's something going on. Russia's now pulled out of that assembly. We've had Ukraine pulling out of that assembly with Ukraine's president pulling out. So something's underfoot. Now, markets were sort of started the session today a little bit buoyed because there was seen to be some positive developments over the weekend. Now, the positive development was President Putin on Friday said that there have been some positive shifts, okay? But he didn't give any details what those positive shifts were. President Zelensky said that he was willing to compromise if Russia would. So that was positive for risk sentiment. And Russia's taking sort of constructive steps, according to Ukraine. So there was sort of seen a little bit more optimism. Maybe there could be a deal struck. Now, if there is a deal struck, let me explain to you what it's likely to be. Okay, just so you know what any deal is that comes out. So I'm just going to pull up a NATO map here, so you can see. I'm going to keep one eye on the trading opportunities. Right now, this is. Let's just look at let's open image in new tab. Right, this is really important. So basically, all the countries in blue are NATO members. The darker are older members. The lighter is more newer members. Now, this is Ukraine in the yellow. So Ukraine wants to join NATO. Now, this is Russia over here. See this border here up to Finland and Norway, right? That is all Russian territory. Russia don't like NATO on its borders. This is Estonia, Latvia, Lithuania up here. This is Ukraine. This is Belarus. Now, Belarus is pro-Russian. Ukraine is where Russia has invaded. That's the Crimea. So any deal that's done will likely be in the scenario where Crimea becomes Russian. There's a couple of regions down here which are very sympathetic to Russia. They're right on the Russian border. So that's like Donetsk, Luhansk. So if we see Donetsk and Luhansk becoming independent, Crimea turning to Russia, and Ukraine joining not to join NATO in the next sort of 20, 30 years, that would be positive for risk. Okay, we'd likely see a risk recovery. There is a headline breaking. I'm seeing a little bit of downside, but I haven't. Okay, no, just carrying another headline from Boris Johnson, so nothing in particular there. Okay, so the stock started a little bit stronger to start the week. That's fallen off a little bit on those negative sentiments. So where we're at is markets are balancing geopolitical risk with Russia and Ukraine, but that's not the major risk, strangely. The other factor that's weighing on stocks is the stagflationary risk, and that is that inflation is high as growth is slow. Now, all the central banks around the world, really pretty much, apart from maybe Bank of Japan, are starting to worry about inflation. Now, the ECB met last week, and they made it clear that they're worried about inflation because they're going to end asset purchases in the third quarter of this year. And then they said they were raising interest rates, sometime after or shortly after. So they're recognizing that inflation is a big risk. Now, the Fed are meeting on Wednesday this week. We'll get to it in more detail, but for now, what we have to realize is if the Fed keep hiking interest rates aggressively, higher interest rates means higher mortgages for consumers, which means less disposable income, which means less profitability for US companies. So as central banks raise interest rates, that makes conditions for business worse. That's why stocks have been falling on expectations of interest rates rising. So if central banks have to hike interest rates to contain surging inflation, then that just results in a downside in stocks. So if you look at the S&P 500, you can see that from the year's highs, it's fallen about 15% maximum. Now, if the S&P falls down to that 373 region, normally these kinds of falls would result in a US recession. Historically speaking, when you see the S&P 500 falling like 21, 22%, normally that ends up being a US recession. So this means the Fed has a little bit of space when they meet this week. If they hike interest rates very aggressively, if they surprise with 50 basis points, they do have a little bit of a downside to play with before a recession becomes almost like a dead certainty, which is around that 3,700 region. So this is the area you'd expect to see some dip buyers around this 3,700 on bargain on stock value. Okay. For now, markets, the Fed will be quite happy with the S&P 500 being at this level. Remember, it's a fall, and it feels like a bad fall, but it's within normal parameters for a correction in a rate hiking cycle. Okay, there's nothing unusual about this. There's kind of levels where the Fed would start to think, oh, hang on, we need to be slower in hiking interest rates. So that's just to tell you that, yes, geopolitical risk is weighing on stocks, but stagflationary risk sits underneath. So now you understand that key dynamic that's going on, okay? Now, with that being said, now let's look at the major events that are taking place in the calendar. And let me just going to open the chat box and the Q&A box. If you've got any questions as we go through, we'll talk it through. First thing here is the monetary policy meeting minutes from the RBA coming out overnight. Now, if you go to this blog here, now this is my blog at HYCM, okay? And you can just follow my blog there, and I do update the blog regularly, every day in fact, right? And I look at key events. Now, in the Central Bank Watch, you can go there, and so the last RBA meeting, you can see that I mentioned the RBA seems to be at a turning point. Now, the key driver for that turning point is RBA are saying, look, inflation is not sustainably within our target range, but their target range is 2 to 3%. Now, they forecast the core is going to drop to 2.75% in 2023. So it's higher than that for 2022, then it's 2.75%. So in other words, they see it within the target range for 2 years. Now, I question that. That seems sustainable to me. So I think the turning point has been reached for the RBA to turn more hawkish. This is why I was expecting Aussie yen upside from this meeting. Okay, it just made sense with the RBA not having a reason really to maintain a more neutral bias. Now, the minutes are going to be important because what do we learn about the RBA? Now, we know that they want wages to be at 3%. If wage prices are rising at 3% year on year, the RBA have said that will be the signal that tells them inflation is sustainable. So we know that, but inflation won't be going on now. We won't get the wage price data point till April now. So we've got a long time to wait. So will the minutes give us a clue? Perhaps there's a bit of nuance. Maybe some board members did think inflation was sustainable. You know, we'll be looking at that, and you could see some more upside in the Aussie. So check out any fallout from that meeting. Okay, on Tuesday, the next area to get is PPI. Now, this is the Producer Price Index. Now, this lets us know what's going on with US inflation. Headline inflation in the US is now nearly 8%. Huge inflation pressures. That's partly because demand for goods and services, particularly goods, remained high during COVID-19, but a lot of people retired early. I think there was about 5.5 million people that left the US workforce during COVID, and 3.5 million of those were early retirees. And if you think about it, with stocks being so well supported during the crisis, many employers took advantage to retire early because their pensions would have been very, very high, okay? It would have been great opportunity for people to retire. Now, the PPI will tell us what inflation pressures are still in the system. So this is the Producer Price Index. In other words, what prices are producers having to pay? If that increases, what happens to costs? Eventually, rising producer prices results in further inflation. Now, it doesn't always happen. Just because it costs a company more to produce something doesn't necessarily mean that inflation will be passed on. But more often than not, it does. So if that's high, that increases the inflationary pressure narrative, okay? Now, Wednesday is the big day because we've got the Fed meeting. So these other data points are likely just to be less important. Retail sales will be important for the US, but it will be overshadowed by the FOMC rate meeting. Now, let me just show you what's going on here. The FOMC is expected, and this is from the great research done by Financial Source. You can see here that the next meeting date is 6.9% is the expectation. There's meant to be 6.9 rate hikes. So that is what the market's expecting for the Fed. Now, how hawkish will the Federal Reserve have to be to maintain this market bias? In other words, very hawkish. And if you just take a look at this research here, you can see, and I think this is from JP Morgan research, which is that when the Fed hikes, you see the dollar rising 6 months before the first hike, and then after the hike, you tend to see the dollar weakening. So, in other words, when we get to the interest rate decision on Wednesday, yes, look, the Fed are expected to hike by 25 basis points. But look, the market is implying that they're going to raise interest rates nearly 7 times this year. So what does that tell you? That tells you that the Fed are going to have to be extremely hawkish to keep prices, the dollar, moving higher. So what does that tell us about the major pairs? Well, it tells us something really significant. Now, this is where we have to balance two narratives. So narrative one is geopolitical risk, and that results in dollar strength. That's why the dollar's been rising recently. It hasn't just been on the expectations of the Fed hiking, it's been mainly on geopolitical risk. And you can see that as the Russian-Ukraine crisis has got worse and worse and worse, the dollar's been bid and bid and bid. Now, if the geopolitical risk fades, we expect the dollar to weaken. And that would mean pairs like the euro-US dollar and pound-US dollar could potentially have a really big surge higher. So that's the obvious trade. If geopolitical risk fades, say there's a ceasefire, there's peace between US and Russia, then you'd expect, not US and Russia, peace between Russia and Ukraine rather, then you expect euro-US dollar and pound-US dollar to rapidly retrace higher. There'll be buys at market, okay, for both of those pairs. Now, what we're looking for at the actual interest rate decision is the Fed may not be as hawkish as the market is expecting, and that would result in some dollar weakness. We'd also expect New Zealand US dollar upside, so look out for that. Now, the Fed might hike by 50 basis points, so that is always a possibility, particularly if the expectations are so high. Now, if you look at the Bank of England, by contrast, the Bank of England are also meeting this week, and the market is currently expecting them to hike interest rates 6 times this year. Now, that seems very unlikely. So there is a high probability that the Bank of England is not nearly as hawkish as the market is expecting. Okay, so we have to watch out for what's going to go on with the pound. We'll cover that in a minute. But for now, look at what happens with the dollar in relation to geopolitical risk. Now, GDP, if that comes in high for New Zealand, we expect further upside in New Zealand dollar yen. Okay, so New Zealand dollar yen, it's been a very nice pair that's been moving, tracking consistently higher. And it does look like the New Zealand dollar yen is looking for a move back up to that 81.90, 82 region. Now, the New Zealand dollar yen has been gaining on risk on and risk off. Now, let me explain why the yen is so structurally weak. If you look at Japanese 10-year bond yields, what you'll notice is that the bond yield is stuck between this plus 0.25% region and the minus 0.25% region. That is deliberate. The Bank of Japan has said that they will keep the bond yield between that level. And the reason they're going to keep it between that level is for the very simple reason that they want to keep the yen weak. Now, Japan has an export economy, which means a weak yen makes Japanese exports more competitive. So that's number one reason why the yen is going to be weak. Number two, inflation in Japan is like plus 0.50%. In the US, it's like nearly 8%. So Japanese inflation is low. There's no pressure on the Bank of Japan to hike interest rates. Number three, high oil prices pressure the Japanese yen because Japan has to import a lot of its energy. So when oil prices are high, that keeps the yen weaker. That keeps the yen weak. So that means that the yen is structurally weak. Now, the RBNZ are expected to hike interest rates to 3.3%. That's their terminal rate. So this New Zealand dollar yen bias remains in place. Now, closing above this, if we can close above that area, buying at market, stops underneath 79.26 makes sense. Looking for a move up to 81.90 in the New Zealand dollar yen. I've been structurally long the New Zealand dollar yen for a while. I've got a couple of positions coming in from this bottom of this range. And I'm ultimately looking, this could potentially go even higher. And if you look at this from the monthly chart, what you can see is there's actually a hidden bullish divergence here, with price making higher lows and the indicator making lower lows. That makes a case for a move back up to that sort of 84 region. Okay, so could easily see 84, maybe even 88 on this, and just pushing above this key level, here makes a lot of sense. So looking for further New Zealand dollar yen upside does make sense. And the GDP, if that comes in high, that could be a good catalyst for the New Zealand dollar to keep gaining. Aussie, now what we want to see for the employment data is that needs to remain strong. Unemployment rate, 4.1% is great. If it comes in like 3.9% and the employment comes in at 40,000 plus, and the majority of those gains are full-time workers, that supports Australia's mandate for more Australian dollar growth. But here's the problem at the moment. You see these commodities. This is one of the things that's been really supporting the Australian dollar recently, which is very high iron ore and coal prices. Now, there's a strong correlation between iron ore and coal prices and the Australian dollar. Please excuse me. I've got a little bit of a cold, so I have to apologise for my hoarse voice at the moment. The iron ore prices have been really supported higher, so have coal futures. Now, all of that has supported the Australian dollar. If the geopolitical risk fades, we'd expect the Australian dollar to correct lower. Okay, so what we have to watch out for is, yes, it's not that employment's important, but if it's strong, that's not likely to result in much upside in the Australian dollar. The greater risk if it's weak. So if that's a disappointment, if unemployment goes higher and employment is a disappointment, then you can see a short, sharp lower in the Australian dollar. But again, you'd expect those dips to be bought, because the overall outlook for Australia is pretty optimistic. So there's not that much of an opportunity from this. Bank of England meeting on Thursday, and they are expected to hike interest rates by 25 basis points. If they surprise markets and did like a 50 basis points rate hike, then you'd expect a short, sharp move higher in the pound. But that wouldn't necessarily be long-lived. Okay, so it'd be a quick opportunity to scout maybe like 20, 30 points, but apart from that, wouldn't expect that to be long-lived. But what would help the pound is, say, geopolitical risk fades, number one. Number two, the Bank of England maybe hike by more than 25 basis points, and they show fresh concerns about inflationary fears. And the Fed were more, not as hawkish as the market was expecting. And on top of that, we started to get some good wages come out. Wage data comes out for the UK on where the wages for the UK. Let me just find that. Here, if the earnings come out strong tomorrow, so you want one, strong earnings, which will raise concerns that wages are starting to move higher. That will get the Bank of England nervous that they'll have to hike rates more aggressively to control inflation. Number two, the Fed's not as hawkish as the market was expecting. Number three, geopolitical risk fades. And number four, maybe the Bank of England hike by 50 basis points. If we saw those things happening, then we could start to look, and would definitely be a strong case for pound US dollar upside. So you'd expect the pound US dollar to move back higher and retest that 1.35, 1.36 region. So what we're looking for here is the fact that maybe this has been a bit oversold. Now, the other option is, right, if the geopolitical risk carries on badly, if the wages are, a disappointment, and if the Bank of England is less hawkish than the market is expecting, and remember, markets are pricing in 6 rate hikes from the Bank of England this year, which seems far too high. So there's also opportunity for maybe more downside. If we see more risk-off trading, we expect more bids into the dollar, so more pound US dollar out downside. So the risks are there, but should we get a recovery in risk sentiment, pound US dollar and euro US dollar are the best opportunities for the week. The other options we could look for is something like pound Australian dollar or euro Australian dollar. Both of those would make sense as well. I think the most straightforward trade that's still open now is like New Zealand dollar yen upside, looking for a retest up to 81.90. But that's some ideas, you know, that I'm looking at. Got Bank of Japan monetary policy statement, no surprise expected, but if they start getting nervous about the bond yield spread, not the bond yields, if they start getting nervous about this bond yield and don't defend that level, then you could expect to see some more yen strength. But for now, as long as the Bank of Japan maintain their dovish stance, then we expect New Zealand dollar yen upside in the medium term. Okay, folks. Another thing to look at is gold prices. Gold is getting quite a lot of press at the moment, and what's pushing gold is the move in yields. So if you just take a look here at real yields, you can see that as real yields fall, blue line, gold rises. Now, what's real yields? That's just the 10-year yield minus inflation expectations. So with inflation high and inflation rising higher than yields are rising, that means real yields drop. That supports gold. So if we see risk-off trading, if geopolitical risk gets worse, real yields will fall, expect more gold upside. So that means short-term trading opportunity. If geopolitical risk gets worse, expect gold upside. If geopolitical risk gets better, expect gold downside. That's a simple way to trade gold right now intraday. What else is there? Yeah. Okay, folks. Yeah, that's the main issues. Any questions? Please do pop it around. Stefan, great question. Does a deal struck completely rule out any possibility of a Russian default? Regardless, what are your thoughts on a potential Russian default? Yes. Now, I haven't given a potential Russian default a lot of thought, Stefan. Now, if a deal is struck, that is much more likely to rule out the possibility of a default, because what you'd expect, Stefan, is countries to start putting their businesses, start their commodity orders going back to Russia. So yes, I'd say a deal struck should make the possibility of a Russian default significantly less likely. If there is a Russian default, I would expect that to weigh most heavily on the euro and the pound due to the proximity of Russia to Europe. So if there is a Russian default, expect that to weigh heavily on the pound, the euro, the DAX, the FTSE 100. I'd expect strong bids into gold in that situation. I hope some of that helps, Stefan. Nikita, view on silver. Silver has a very similar outlook to gold. Okay, if we just compare the silver chart to the gold chart on this, we'll just do a quick overlay. Okay, what you can see here, do you see how silver and gold are tracking each other very closely? So what we're looking for here is exactly the same outlook for gold. If risk, if we just go to the silver chart, you can see here, right? If risk turns more negative, right, then you expect silver upside. If there's a deal struck, geopolitical risk phase, you expect silver to fall. So that's the basic situation we're looking at, Nikita. Okay, exactly the same outlook as gold. So, for instance, if you think like the geopolitical risk is going to continue, then like going long from market with stops underneath 25 makes sense, looking for a move back up to 26. If you think the geopolitical risk is going to fade and that there's going to be some kind of Russian-Ukraine deal, then going short silver or gold with a break of that trend line would be an easy way to define and limit risk. Personally, for me, I'm staying out of both of them, Nikita, because the geopolitical risk is so uncertain at the moment. I hope some of that helps. Any thoughts on the Canadian dollar? Yes. Now, one of the big drivers of the Canadian dollar is obviously oil prices. When oil prices surge, that supports the CAD. Now, this week, in terms of Canadian data, we do have some inflation data out of Canada. Now, if you take a look at my blog, you see I do update the latest interest rate decisions. And you can see what happened at the last meeting is the Bank of Canada is leaning more hawkishly, and the main concerns is that inflation does not run hot. They're prepared to act on rising inflation, and that should mean a solid CAD yen long bias has opened up with Japan. So you can see that was from like 4th of March. So that solid CAD yen bias. Let's just take a quick look at CAD yen from the 4th of March, and you can see that that solid bias has been, justified with a decent amount of upside in the pair, right? From going back from like the 4th of March, right? So you can see CAD yen just continue to move higher. Now, if inflation comes in much higher than the market expects, so say the core, the median comes in, like 3.9%, and the core comes in, let's have a look for if the trimmed and the mean come in, 4.4%, that's like 3.7%, then you can expect significant CAD upside. So CAD yen upside would make a lot of sense then. Okay, so that's what I'll be looking at there, Naha, is any high inflation print coming out on Wednesday. But remember, the Fed meeting on Wednesday, usually what happens is markets just go very tentative and quiet. So the idea would be if the CPI is strong, but the Fed is not as hawkish as the market was expecting, one pair to be looking at would be like US dollar CAD shorts. But that would have to be in the scenario where the Fed is not as hawkish as the market was fearing, and maybe inflation is high for Canada. And if you look at oil, can you see that usually that this is oil markets inverted in the green chart, Naha? You see that when oil prices green rise, you see the scale here on the left, here it's going up. This is oil in the green, and this is inverted scale. So that line going down is oil prices going up. As oil prices go up, dollar CAD falls. Oil prices go up, dollar CAD falls. Oil prices go up, dollar CAD falls. Okay, so oil prices have gone up, but notice dollar CAD hasn't fallen. So if we get a more dovish Fed or geopolitical risk fades, dollar CAD shorts make sense. You can use that level to lead against, looking at a retest of 1.2200. Does that make sense, Naha? Yeah, Nikita, good. Yeah, you got it. Excellent. Very good. Okay, folks, that's all for now. Thank you all very much. And don't forget to come back on Wednesday and we'll look at the Fed meeting in more detail. Take care and thank you all very much. Goodbye now.